Are you tired of seeing a significant chunk of your hard-earned money being eaten away by taxes? Do you find yourself wondering if there's a way to reduce that tax bill and keep more of what you've worked so hard to earn? Well, you're in luck. Because in this video, we're about to unveil exactly how you can take control of your finances and minimize your tax obligations. From practical strategies to valuable insights, we've got you covered. So, if you're ready to discover the secrets, don't forget to hit that like button and hit that subscribe bell to stay updated with all our valuable content. Let's dive in. Understanding how income tax is calculated. Think of our exploration into income taxes as an exciting adventure where we uncover the secrets behind how these taxes are figured out. It's like solving a big puzzle. Each piece we find helps us grasp how the whole tax system works. And speaking of puzzles, there's a common misunderstanding we need to clarify. Many people believe that as you earn more money, you end up paying higher taxes at a bigger rate for your entire income. For instance, if you start earning more and move into a higher tax bracket, you might worry that you'll have less money left after taxes. But wait, there's more to this story. Different countries use what's known as tax brackets. Imagine these as different levels of income, each with its own tax rate. Picture climbing stairs where each step represents a different tax cost. So, let's say your country has 3 tax brackets and you make $60,000 per year, putting you in the 40% bracket. You might think you owe 40% of your $60,000, that's $24,000 in taxes. However, it's not as straightforward as it seems. Now, let's unveil the key concept here. The progressive tax system. Think of it as a sliding scale where various parts of your income get taxed at varying rates. Imagine it like a musical scale with different notes playing their roles. At the start, a certain part of your income, let's say the first $10,000, might not be taxed at all. Then comes the next portion, about $40,000, which could be taxed at 20%. Finally, the remaining bit, let's say the last $10,000, might face the highest tax rate of 40%. When we add up all these parts, the actual tax you'd owe on your $60,000 income is $12,000. That's how these puzzle pieces fit together to give you the final tax amount. Remember, each country has its own set of rules for taxes. For instance, in the UK, earning a higher income might change how much money you're allowed to earn before taxes start being taken out. This is called your tax-free allowance. Before we dive deeper, make sure to hit that like button if you're finding these insights helpful. And if you're hungry for more money-savvy tips, don't forget to subscribe. Done? Okay, let's get back to our tax journey. Now, let's explore ways you can pay less tax with a step-by-step approach. And let's delve into how each strategy can effectively reduce your tax bill. Pension contributions. Imagine your money as a pie that you can strategically slice. Consider setting aside a portion of your earnings into a pension account. This pension functions like a secure vault for your retirement years. What's truly smart about this approach is that the portion you contribute to your pension isn't subject to taxation. By reducing your taxable income through these contributions, you're effectively lowering the amount of your earnings that the government can tax. This means that you're not only saving for your retirement, but also decreasing your current tax bill. For instance, if your yearly income is $60,000 and you decide to allocate $500 per month to your pension, only $54,000 of your income becomes subject to taxation. Over time, as your pension fund grows, so does your financial security in your later years, all while minimizing your present tax obligations. Employer matching. Now, let's build upon this concept. Some employers might sweeten the deal by matching your pension contributions. Think of this as a bonus boost to your pension fund. And the best part is that it escapes immediate taxation. This matching contribution not only enhances your retirement savings, but also further decreases your current taxable income. By receiving this extra contribution from your employer, you're effectively reducing the portion of your income that's considered for taxation. This double benefit has a notable impact on your tax bill and can substantially alter your overall financial outlook. Keep in mind, however, that these funds are typically locked until your retirement. Running a side business. Now, let's switch gears and talk about running a business on the side. Treating your side gig like a real business might help you pay less tax. When you run on a business, you can deduct legitimate business expenses from your total revenue before calculating taxes. This strategy effectively reduces the amount of income that's subject to taxation. By subtracting expenses like tools, supplies, marketing costs, and other necessary expenditures, you're effectively lowering your taxable business income. This lower income translates to lower taxes. To illustrate, if your side business generates $60,000 in revenue, but you've invested $10,000 in necessary business expenses, you'd only be taxed on the remaining $50,000. This strategic approach is like uncovering a hidden path, one that can substantially lower your tax liabilities while simultaneously encouraging entrepreneurship. Investment accounts. Now, imagine there's a safe where the government can't touch your money. This is somewhat analogous to a special investment account. In some places, when you put money into this safe, they call it a stocks and shares ISA or a Roth IRA. Any money you make from your investments isn't taxed. The catch is you usually can't take the money out until you're older, but it can be worth it. This strategy presents a unique opportunity to not only grow your wealth through investments but also shield your gains from taxation. When you invest in accounts like a stocks and shares ISA or a Roth IRA, any profits you earn from your investments are not subject to immediate taxation. This means your money has the potential to compound and grow over time without being eroded by taxes. While there might be limitations on withdrawing the funds until a certain age, the long-term benefits can outweigh this restriction, providing you with a solid foundation for your financial future. Helpful platforms. If the world of taxes feels overwhelming, don't worry. There are helpful platforms like Trading 212. It's like having a friendly guide to investments. They let you practice with fake money before you start using your real money. Just remember, take your time and don't rush. These platforms offer a unique advantage by providing a user-friendly environment to learn about investments and make informed decisions. Think of it as having a knowledgeable companion by your side, offering insights without the pressure of using real money. The practice mode allows you to gain confidence, test strategies, and understand the market dynamics before committing your actual funds. This patient approach ensures that you make well-informed decisions that align with your financial goals. In conclusion, understanding income tax is essential for effective financial planning. By grasping the concepts of tax brackets, progressive taxation, and strategic approaches such as pension contributions and treating side gigs as businesses, you can minimize your tax liabilities. Exploring specialized investment accounts can also provide tax advantages while growing your wealth. Remember, knowledge is your ally in managing taxes and making the most of your earnings. And there you have it. Now, it's your turn. Did you find these insights helpful? What's your go-to trick for tackling taxes? Drop your thoughts in the comments below. And if you had fun on this tax adventure, remember to hit that like button and subscribe for more money-savvy tips. Until we meet again, keep unraveling the mysteries of finance.